Today's topic is on budgeting. Even prior to the pandemic, nearly half of American households could not pay for an unexpected expense of $400 or more without selling something they own or borrowing the money. This is a very difficult situation to be in as it is incredibly stressful and greatly diminishes the joy of life. If you thoughtfully engage the topic of personal finance, you can move into adulthood comfortably handling your own money management and not having it be an obstacle to your personal peace and happiness. Today, we're going to learn the primary components of a budget and how one is created and maintained, different types of income and how taxes apply, learn about some useful budgeting concepts such as fixed and variable expenses, learn how short-term and long-term financial goals are set and utilized, and learn tips on how to keep your budget relevant. An excellent quote from Napoleon Hill concerning goals is that a goal is a dream with a deadline. The advantages of having goals is that they help dreams become true. Do you have goals? If you do, it's the start of having a richer, fuller life. Goals are advantageous because they motivate us into action. Budgeting is a key action to help us attain our goals. Lastly, always have short-term and long-term goals. The attainment of short-term goals fuels our motivation to continue our efforts toward our long-term goals. A budget is a summary of your planned expenses compared with your planned income for a predefined period of time, or stated more simply, a budget is a plan for your money. Budgets are used by many different entities, including businesses and government. Budgets help provide accountability on how money is spent and are critical in sound financial practices. We, as individuals, can greatly benefit from having a budget for our financial approach. One of the key aspects of budgeting is knowing when to do a budget. In other words, when do we put in place a new plan for our money? Remember, you do not continually budget, but you work to execute on a budget that you put in place to achieve your goals. It's critical, though, to know when to do a budget because if you're unaware as to when to do a budget, a unique moment could pass you by and you could lose an opportunity to firmly establish a sound financial approach. You should create a new budget anytime you have a change in income, increase or decrease, or a consideration of new spending or savings. For example, if you start a new job, that increases your income. Before you change anything in your lifestyle, you should develop a new budget. Every new dollar earned should be directed towards a specific purpose or goal. A lack of budgeting is a key reason why many Americans are living paycheck to paycheck because when they receive new income, they begin a habit of increased yet purposeless spending. Unfortunately, they can easily find themselves in a lifestyle that is not financially sound, and even when they realize their dilemma, it becomes very difficult for them to change a bad habit. So when you receive new income, immediately devise a budget. Also, if you want to increase your spending, you should first devise a possible new budget to see if you will be able to afford it prior to changing your spending lifestyle. Do you change your lifestyle in any way? Do not change your lifestyle in any way until you first devise a budget to see if you can afford it. When discussing the basics of budgeting, let's first talk about income. Earned income comes from your job. A portfolio is something that a person lives on after they retire and are no longer working. Components of a portfolio usually include stocks and bonds accumulated as a person invests during their working life. Lastly, there is gifted income. It's a good philosophy to not count on gifted income. The expectation of gifted income can diminish a person's motivation to work hard and be resourceful. If you're fortunate to receive money as a gift, for example, a part of an inheritance, first be thankful and then set the money aside in a savings account. Then take some considerable time thinking about how you would want to use the money. Even with gifted money, it's wise to have a thoughtful budget so that you are taking the fullest opportunity to optimize this unexpected gift. We'll talk about fixed and variable expenses in a moment, but many times it's natural to think that our income minus our expenses should be a net positive, but a more precise way to think about it is that income minus expenses should equal zero. And if we think about the expenses category, should ideally be a circle on top of the fixed and variable categories that would be stated as disposable income. Even your disposable income, which would be what was left over after your expenses are deducted from your income, should be carefully planned. If you have a net positive income and you don't plan how to use it, you could lose a great opportunity to direct that disposable income in a manner you most value. A great way to use disposable income is for your short-term and long-term goals. Think of it this way: every dollar gained should be a part of a thoughtful budget, a plan for your money. There are two types of expenses, fixed and variable. Fixed are expenses that have a scheduled payment each month, for example, rent. Variable expenses, by their very nature, fluctuate with our activities. We can get into trouble with both fixed and variable expenses. If we get into an apartment that we really can't afford, eventually we will probably be forced to leave the apartment and more unfortunately hurt our relationship with our roommate who is counting on us to be a partner with them in paying the rent. Variable expenses need to be planned as well. Any activity in which you spend money should be a part of a budget. Needs are items that are required for survivability: water, food, and shelter. These items have quite a range in cost. For example, you can use water out of a tap, which is very inexpensive, or you can purchase bottled water, which can be very costly. When you first go out to live on your own, if you rent a one-bedroom apartment and live by yourself, it could cost you around $1,200 a month. But if you have a roommate and share a two-bedroom apartment at $1,500 a month and split the cost, you would only be paying $750 for your share of the rent. This one decision would have over a $5,000 annual impact on your budget. Want items are not necessary for survival, but they do help you enjoy life, and you should have a thoughtful decision-making process for how you purchase want items. Possible questions to ask yourself: how many times will you use it? Will you use it longer than a year? If I wait 24 hours, will I still want to buy the item? One rule of thumb is the greater the cost of the item, the longer a person should wait to consider whether they really want to buy it. One of the first critical financial moments that everyone experiences is when they obtain their first full-time job that allows them to live on their own. So I'm going to show you an example of how you would do a budget when that moment occurs. Remember, this is a time to create a budget because you will have just received an increase in income. Let's assume you start at $45,000 per year, which is the amount an average Oregon college graduate will earn in their first job. That equates to $3,750 per month and $2,750 a month after taxes. After you secure your first full-time job, wait until you receive your first paycheck before you create a budget. Only then will you know how much has been taken out for taxes, and you'll know specifically the net income to use to calculate your budget. As an example, Americans on average use 35% of their net income for housing, so the calculation would be your net income of $2,750 times 0.35, which equals $962.50. On the other side of the table, entertainment is calculated as $2,750 times 0.05, not 0.5. Be careful of that distinction, or $137.50. Hopefully the information provided will allow you to be comfortable with the remaining calculations that would need to be done in this example. It's important to conduct the same approach when you do your budget prior to leaving your parents' house to live on your own. Possibly a simpler approach could be what is called the 50-30-20 budgeting rule. 50% would be on your needs, 30% on your wants, and 20% on savings. This is just another example of a budgeting approach, and the calculations conducted in the previous slide would still apply. After you created your budget, it's critical to track your expenses to make sure your budget is actually working for you. One method that provides an automated approach to track your spending is Mint.com. Note the YouTube reference if you'd like to explore this easy yet free approach. A manual approach would be to document all of your spending in an Excel spreadsheet. You could take all of the line items on your debit and credit card statements and categorize each line item, for example, entertainment, and then manually input the totals in your spreadsheet. It doesn't matter how you track your spending, it's just critical that you do so that you make sure that you're staying compliant with your budget. After a while, you'll start to get into a spending rhythm, and the need to closely watch your spending each month will diminish. But it's important to track your spending immediately after you create your budget for the reasons noted. Unexpected expenses could bust your budget. To avoid that from occurring, it's important to establish an emergency fund prior to moving out on your own. Ideally, an emergency fund should be equal to 6 months of your budgeted expenses. The best moment to establish an emergency fund is when you've attained the job that will allow you to live on your own. Instead of immediately moving out and using your new income for rent and food, direct the money to your savings account to establish an emergency fund. It's as simple as this. Each month you stay at home is a month that you could be putting aside the value of a month of expenses into your emergency fund. The main reason most Americans live paycheck to paycheck is because they do not have an emergency fund. In short, do not leave your parents' house before establishing your emergency fund, if at all possible. Key takeaways. Create a new budget anytime you have a change in income, increase or decrease, or a consideration of new spending or savings. Track your spending after you establish your budget to make sure it's working for you, and fine-tune as needed. If at all possible, do not go and live out on your own prior to establishing an emergency fund. If you succeed in executing these critical elements of personal finance, you'll be well on your way to establishing a financial foundation that will provide you a significant amount of comfort and peace in your life.